Welcome to this week's episode of What's at Stake. We're your hosts, Bryan DeAngelis, partner here in the Washington office for Penta.
And Ylan, managing director at Penta.
And today we're bringing back our old friends. We're here to talk about the economy and the Federal Reserve's plan for interest rates with John Fagan and Brendan Walsh from Markets Policy Partners and the Macrocast. It's great to have you both back on, get the gang back together.
Yep, you got to pay us this time.
That's right.
We'll pay you in water and coffee. How about that?
Yeah.
Talk about inflation.
Yeah, I'm stocking up on my drinks when I leave.
Well, guys, there is so much to discuss. So let's just start with the Fed leaving interest rates unchanged at its most recent meeting, but signaling that it could still cut rates 3 times by the end of the year. Clearly, the markets like this news. What did you guys think about it?
Yeah, it was sort of the way that expectations had played out. This was really in line with the consensus, but the consensus has gotten a little less confident about where the Fed was really going with its rate cuts. And if there was a chance that the dots would move into a more hawkish position for 2024, specifically that median dot drifting down from 75 basis points to 50. That was what market participants were kind of waiting and watching for, very in particularly going into this meeting. And as it played out, the 2024 dot stayed steady at 75 basis points, despite the fact that we did get those, slightly hotter than expected inflation readings in the past few months. And the Fed simply, declined to overreact to those, I think, is a good way to say it. And I think Chair Powell's is getting a lot of, and I think properly so, a lot of accolades about his performance in the press conference. He seemed calm, in control, and confident. Expressing uncertainty appropriately, but certainly not being buffeted by the noise in some of the recent data points that we've gotten.
Yeah, and beyond just this last meeting, I think he's really handled himself and the Fed very well, because when the Fed did that kind of surprise pivot at the end of the year and announced, okay, we're going to start the easing cycle in 2024, the market massively overreacted, and they started to price it in 6. And Powell and the Fed just stuck to their path, and they said, well, I think you're probably overreacting. We're going to maybe 4, maybe 3. And now the market has finally come back to what the Fed's been saying all the time. We'll see what happens with the economy and everything, and whether we get those 3 or more or less. But they've stuck to their playbook, and I think the market now is settled down, and the equity markets kind of fascinatingly took this whole kind of thing in stride, and the market's up like 10% on the year.
I have to jump in and ask the political question. I know the Fed and Powell have to be apolitical, but they're obviously aware of what's going on around them.
Yeah, and that's why I think they did the pivot at the end of last year, so that they could tell the markets what's coming, so it wouldn't be perceived as, we're cutting to help one candidate over the other.
But they got to start cutting soon then, right? Because 3 cuts for the rest of the year. I mean, we're getting pretty close to the election. These will be big news and cuts, right before we go to the polls.
Right. So, John, the first one now, the market is pricing in for June, correct?
Yeah, June, going into this meeting, June had been kind of a coin flip. It had been sort of drifting lower odds implied in the futures markets that the Fed would begin cutting in June. There was a sense that June is probably the, politically and optically the best time or the last chance for the Fed to get going on a rate cut cycle. I think that's sort of overplaying the role of politics in Fed decision making, specifically if, as Brendan said, the Fed has really been setting the table for this for a long period of time. If they're going to get dragged into the political mire, like so many other institutions in Washington, D.C., it's not going to be because they started cutting in June versus July, right?
Right. They may be underplaying the political reaction we'll see from Trump. Whether you cut in December or June, he's going to go after you.
Right. But when they do announce that first cut, it won't be, here's this cut and we'll see what the future is. It'll be, here's this cut and we're planning the next 2.
Couple.
They'll lay that out for the rest of the year.
Yeah, there was a sense that June was because you hadn't gotten to the the conventions yet, and the July meeting is like really late July, and so when the campaign is really in full swing, and so but the data is, the Fed has really set out their path. And, I think that July is the fact that June odds didn't spike up to like 80% or 90%. They're still, relatively, they're higher than they were. But it's not, overwhelming like landslide expectations of a June start. I think the Fed has, created such a balanced path and written the playbook out for us that they can probably get going in July and still get their 3 in without tripping any political wires any more than, it's hard to avoid sometimes catching flack from on the political front. So we're still kind of thinking that, maybe that July looked like it's a perfectly live meeting, and the data might push them in that direction if we still get some stickiness. And I think that they've set the table for that to be, okay, and they can still get their 3 in, maybe skip the November meeting, right?
Yeah. I was just going to ask, what are you guys predicting? Is it sort of July, September, November? I think might actually come after Election Day, if I remember the dates right, or do they skip that and go to December?
Yeah, it's if they
not to put you on the spot.
Yeah, if I had to guess, it's kind of a close call. It's almost academic. I'd say they go July, September, December.
Yeah, I agree.
Yeah, that still feels like a pretty aggressive pace to me, considering, how long that they've waited to get this process actually underway. And, I guess it's also a signal that they feel like they can get out of this without a real recession, right? That they're not going to be cutting because they're seeing weakness. They're going to be cutting because they feel like rates are too high, that they have a little bit more flexibility.
Well, that is an interesting insight, because they've held off for so long, and now they're saying we're going to give you 3 at the end of 24, and then 4 in 25 and 4. So if they think that the rate needs to come down, 2% over the next couple of years, what's the difference between starting now and in July? And that's something they're going to have to message.
Well, and I think the conviction for 3 amongst Fed officials was a little bit weaker than it was back in the last time they put out these forecasts. There were still
it was closer.
About half of members saying that maybe we're only going to get 2 or even 1 or maybe even none at all.
Exactly.
Brendan, you just made a point of when they start. He says he wants greater confidence that inflation is moving down. I mean, we're seeing that, but what's your interpretation of what he exactly means there? Like, what does he need to see that he'll finally have that greater confidence? All of them have to see.
Oh, totally. There has been some quirks in the CPI has quirks, and we've talked about it in the Macrocast in the past about how the housing measurements are lagged. So he does know that is going to start to show up. And if it kind of follows the real-time data that we've had for the last 6 months, you actually could have, core inflation rate below 1% by the end of the year. But that's not. I don't think that's exactly what he's talking about. When you look at the latest components, goods prices have they came off really hard, and that helped drag it down. But they've not only stabilized, but they've started to go up a little bit. Part of that is just supply and demand. People are. We didn't buy anything, then we did. Everything, the pandemic screwed it up. But also the shipping problems with the Red Sea is kind of starting to seep in. We saw that in the PPI, which producer prices, which leads the CPI by 3 months. So there are some indications of stickiness in the overall in the last couple of months. January and February are always a little difficult with data because of seasonality issues. So I think that's why he's kind of holding off before he hears that. But there are some indications that, maybe this idea that we're going to, go back to 2 and not have to worry about it ever again might not be the case. But they still do have, I think, their base case is that inflation is normalizing and will allow them to start to ease in the future.
We were talking about this right before we started, but this news around real estate commissions changing, and this could disrupt a little bit the spring housing market. I assume he's looking at that. Is that a big factor
that actually is a
weighting?
component. Real estate commissions is a component of the CPI and PCE. So
Right.
if those come down, that actually does directly feed into the CPI. But it's also an exogenous event. It wasn't because they tightened that real estate commissions came
exactly.
down.
Yeah. A lot of other reasons.
Yeah.
Well, do you think though that we've worked through some of the bumpiness, I guess, in the housing component of inflation, both in the CPI and the PCE? We've been kind of folks have been talking about the need for like super core measures to not look at housing anymore because it was such an outlier in terms of where we're seeing the growth rate and inflation. So do you feel like we've worked through that, or is it something we still
No, I think it's just beginning. So in February was the first time we saw the shelter components start to come down. And if that is the case and it follows what we know happened over the last 8 months, it's going to continue. We actually could have some negative readings on a month-to-month basis, which obviously that massively drags down, especially the CPI, where it's 40% of the core. The PCE uses the same measurements, but they weight them different. It's about 23%.
So we could see the headline numbers start to come down pretty dramatically because the housing number is starting to finally fall.
Yeah. But everyone knows it follows it. This is old news, So that's why you've heard so much more talk about the super core, because that is probably a better indicator of what is actually happening on a month-to-month basis. And that is where those goods prices have been kind of showing up and being much more sticky than probably they thought maybe 6 months ago.
The other component that has been super sticky has been services inflation. Where do you guys see that right now? Have those prices come down at all?
So service is always positive. It's just how high they are. And those are always difficult. Wages don't necessarily directly impute into what the services component of the CPI and PCE is, but we have seen some wage moderation. Most components and measurements are kind of showing it's at 5%. So still above the CPI, so it's great for the worker. So you're actually making real gains on your wages when you adjust for inflation. But not even close to what it was a couple of years ago where, it was like 9-10%. So I think that the Fed's feeling fairly strong about wages, but the labor market remains a lot stronger than probably they would have predicted. We just got our unemployment claims today, and they went down 2,000, and they're just slightly above 200,000, which is kind of indicates full employment. But I did see some research a couple of days ago that showed immigration has actually been a lot stronger than the CBO and everyone kind of predicted, which probably explains a lot of what's going on in the labor market. There actually are more workers to fill jobs than we had assumed.
Great.
Which allows us to keep creating 200,000-300,000 jobs a month.
Great. Let's take a quick break. We'll leave it there for now. And when we come back, we'll talk more about how the economy affects the political landscape at home and abroad.
Penta is the world's first comprehensive stakeholder solutions firm. We are a one-stop shop for the intelligence and strategy leaders need to assess a company's reputation and make decisions that improve their positioning. As executives in the C-suite must account for a growing set of engaged stakeholders, all with distinct, fast-changing demands, Penta provides real-time intelligence and strategy solutions. We work with clients solving complex global challenges across a variety of industries. Our clients span technology, financial services, energy, healthcare, and more. To learn more about how Penta can support your company, check out our website at pentagroup.co, our Twitter at PentaGRP, or find us on LinkedIn at Penta Group.
Welcome back to What's at Stake. Let's dive back in. We'll talk a little bit more about the economy and kind of the election year dynamics. So this was the third topic, or maybe even less, that Biden brought up during his State of the Union. And, part of the conversation we had in the first segment of we're getting close to the election now and some of these rate cuts. How important do you guys think the issues are, the economic issue is to voters this year? It seems to be dropping back, but I think as we get more and more news around rate cuts, this could come back on the radar for voters and maybe start to tick back up. How are you guys looking at it?
I'll let John take that one.
Yeah, I mean, it's it's just weird, right? I mean,
Right.
if you're a political strategist and you're looking at the economy through the lens of polls, right, you're getting all kinds of strange data. The dissatisfaction with the Biden's economic record, the preference for Trump's stewardship of the economy, that seems to show through in the polls. I'm sure for the Biden team, that's very frustrating. And
I'm sure
trying
they're
to get
pulling their
message
hair
out.
out. Yeah.
Yeah, right. But you can't tell people that all is well. Just snap out of it. Everything's great, and the messaging here just isn't really straightforward. If the economy is doing as well as everyone seems to think in the economics realm, then why isn't that filtering through to the national mood? And we've parsed in the past some of these elements, that the lingering shock of higher prices, inflation has leveled off to a great extent, but still leveled off at an absolutely much higher level than it was, and everybody's upset and dissatisfied, and there are these little factors that are underneath the surface, like increasing credit card debt, and show that the consumer is not getting stronger necessarily, and there's some of the savings that built up in the COVID era have been burned down and so forth.
So it should be noted that they report those in nominal terms. When you adjust in real terms, it's not in dangerous levels. But it's also kind of ironic for the Biden administration because like two of their big bills, the CHIPS Act and the infrastructure, they kind of stole directly from Trump and did it. And they get blamed for it instead of getting any credit.
Yeah, I saw that today. It actually was announced Intel got some grant through the CHIPS Act. So they're trying to take the victory laps on that right before the election. One thing that I think has kind of stuck with me that we used to talk about on the Macrocast, and I'll give credit where credit is due. This is from our friend John Dick at Civic Science. And, he said that increasingly he felt like the economic outlook, people's economic outlook, was really a reflection of their political positions. So as opposed to the economy swaying people or influencing people to vote Republican or Democrat or for this candidate or the other, it really was the opposite. Depending on which candidate you supported, that was the lens through which you viewed the economy. And I feel like that's what we're really seeing right now with some of the poll numbers and the struggle the Biden campaign has had.
But even more troubling for the Democrats, we actually had John on last week, and they break it out by Republican, Independent, Democrat, and the Democrat view on the economy is starting to soften. Yeah,
I could see that because to your point, Ylan, it's also the Democrats' positioning on a lot of issues is about helping people who are under hard times, is about more childcare relief, it's about more economic stimulus to others. So it's a messaging exercise where it's kind of inadvertently also suggesting things aren't great.
It's presuming that you're still having the hard time, right?
Exactly.
Right. And there's also, the kind of audiences that you're talking to, right? It wouldn't necessarily come as naturally to President Biden to say like what President Trump always said, look at the stock market. It's at record high.
Right.
Awesome and luxurious stock market ever, right? He could be saying these exact same things, but that's not really meeting the swing voters where he needs to meet them. And, things like touting things like, U.S. energy production is also, not necessarily jibing with the narrative that the sort of clean energy narrative that the Biden administration wants to tout when we're pumping record amounts of oil and
even the chips and kind of AI investments. Like people are just not understanding that yet at a living room, kitchen table kind of level. This is not building cars. This is not big manufacturing. It's great jobs. It's great investments, but it hasn't trickled through, I think, all the way where touting those accomplishments are great, but I don't think people are really registering it.
Yeah, and it's the way that the two of them dealt with China. Biden hasn't changed any policies from the Trump administration. We're still, fairly, confrontational with China, but Biden isn't outwardly confrontational.
Screaming about it every day from the.
So Trump would be with the CHIPS Act. Trump would be out there saying,
"Yes,
this is directly
we're winning. They're losing.
Best for national security. We're winning in China." Where Biden doesn't do that, for better or worse.
Well, I guess this is also part of the challenge of, the CHIPS Act and the infrastructure law. I mean, those are all long-term investments, right, that are not really going to pay off for a generation. I mean, they've even talked about it that way. This is a generational investment.
Well, even worse for the infrastructure for the Biden administration is like 90% of them have been in red states because of state level approval process. It's a lot easier to build stuff in red states than it is in blue. So the people that actually have benefited from it were the people that voted against it. Yeah.
Right. So this doesn't necessarily help you at the polls, but even if it might improve the nation's long-term fiscal picture, right? And both of those were bipartisan bills, we should also point out.
Yeah. Right? So the people, I don't know, say you're in Florida and they're building that building to start, doing something big that's going to help us 10 years down the road. But it hasn't helped us as a nation yet. But it has helped that little district that now has, 10,000 new jobs.
And to your point, he's not winning Florida.
So. And he's not winning Florida. Right. Yeah. So it doesn't even matter. Yeah.
Yeah. So the congressional.
That's your prediction? That's
I'm going to go out on a limb there. Yeah.
Bold calls here on What's at Stake.
That's right.
So the Congressional Budget Office released its long-term budget outlook over the past week. And, they did show that the economy is predicted to be better than they had expected last time. But one of the key things they pointed out is that interest payments are expected to double over the next 30 years or so because of this higher for longer stance. So even as we talk about, the Fed looking to start its rate cut cycle, already there's long-term impacts being felt from what they've done so far.
Luckily, we got a Treasury guy to talk about it.
Yeah, well, it's certainly possible that we've just seen the constituency for fiscal rectitude is just essentially evaporating. And part of that is, we've had these sort of, it's the boy who cried wolf phenomenon, right? Oh, deficits are going to ruin the country and all that stuff. We ran deficits and nothing happened, right? And the bond market is still fine and so forth. And so and we had the low interest rates forever. And, when you look out at the Fed's predictions, the expectation for rate cuts and for rates to settle lower and lower, progressively over the next few years into, not back to zero, but again, to a far, far lower, almost half of where we are right now, is the kind of mindset that really has permeated. And when you get the next election cycle coming through, it's hard to see with sort of the populist turn of the Republican Party. The Democrats, not necessarily being the, naturally inclined to cutting entitlements, which would be a major source of budget, budget control, potentially over the near term, over the medium to longer term. Where is it going to come from? So that's, I think it's it would be a very out of the money kind of option, and we've talked a little bit about this and to our clients with it's hard to see a Trump administration really tightening the purse strings, and equally kind of tough to see the Biden administration. But
right.
A Biden administration would have that. If Biden wins, it's more likely that he would be stuck with a divided Congress. When you're thinking about the things that he can accomplish in a second term with a divided Congress, maybe some common sense budget reform is something that he might try. Would he be successful? But he's the kind of president, if you just had what kind of president can possibly do it? It's like an elder statesman in their second term with a divided Congress. That's pretty much it.
It's our dream come true. But you mentioned something there, John, of you still have Congress to deal with, and I don't see a scenario, regardless of who wins the presidency, where we have like a governable Congress again. It's practically ungovernable right now, but the margins, even if Dems win the House or ours win the Senate, I feel like the margins will be so tight that you won't have that ability. You're going to have to truly go old school.
Well, every
to
day there's a new announcement.
everything
Somebody's throwing the hat. It's like, this is a waste of
Someone's
time. I'm leaving.
Yeah, yeah. And, we're dealing with it now where every couple of weeks we're facing a shutdown. It looks like we'll avoid this current one, but they're kicking the can again this September, and we'll see what happens then right before the election. But maybe going full circle, how much is that weighing on Powell's mind? I know he's brought up deficits and government funding before, but he did his 60 Minutes interview, made a big point of focusing on this. Like, how much is he worried about where Congress is going with the way they're managing the budget and the deficit?
Well, I definitely think he's worried. But more importantly, John, I want you to kind of go into more details, because normally the Treasury borrows at rates that are similar to what the Fed funds rate is, because the Fed makes usually good decisions based on the economy. But in a scenario where, say Trump won and he appoints somebody and they cut it to zero, that doesn't necessarily mean the Treasury gets to borrow at 1%, because the Treasury borrows on supply and demand. You're borrowing money from somebody, and they're not forced to loan to you at what rate you set. The Treasury borrows at the rate that the market sets. Correct?
Right. Yeah, and you would see this. An extreme example, right, was and we've talked a little bit about this before in previous Macrocast episodes. The Liz Truss, the short-lived Liz Truss tenure as Prime Minister of the UK, where she had, ostensibly, if you just put those policies that she announced in a brown paper wrapper and took out the context, they wouldn't be, completely out of control. It was like tax cuts and like some energy subsidies, right? But you put it in the context of where she was at the moment in the macro landscape, which was high inflation and, interest rates that were rising, Bank of England concerned about a wage price spiral or stagflation and all this stuff. And you sort of threw her policies into the mix, and it spun the UK, sovereign debt, the gilts market, into just a tailspin, essentially. And you had what they call the term premium, that kind of X factor in the price of longer term bonds, going, essentially going parabolic on them for a short period of time, indicating a loss or an incremental loss of confidence in the ability for debt service to be paid, to be to be viable over a longer term period. It's a scary thing. It's a very emerging markets kind of motif, and seeing it in a big market like gilts was concerning. Could the can it happen here kind of scary question. The bond vigilantes were a thing back in the 90s, right? When the bond market would reject policies that it found to be unacceptable from an investment standpoint. And policymakers haven't had to, be disciplined. They haven't had to suffer, that kind of, or really be constrained by that kind of discipline for a long period of time. And, maybe we're going back to an era where that really is a factor the way it used to be.
Well, speaking of countries that may or may not have total control of their currency, what's going on in Japan? It looks like the Bank of Japan is hiking rates finally, and they brought them all the way to the stunning number of 0 after being negative for 17 years? Forever, basically a lifetime for some people. Longer than my kids have been alive?
Well, I think it was, I don't think they've raised rates for like 17 years, but they've been negative they haven't been negative for all that long. They went negative, I think, in 2016. So I think it's been 8 years of negative interest rates.
Still older than my kids.
Yeah. And there was, this is, the BOJ is obviously very much marching to a different drummer. And that, the backbeat of the everything that the BOJ does is that fear of deflation, right? This is a central bank that is essentially traumatized by decades of deflation. And when they were getting the inflation spike, everybody else was, all other major central banks were hoisting interest rates up in a historically steep a trajectory, and the Bank of Japan sat there and, made these little adjustments with their yield curve control program, which basically pinned the 10-year Japanese government bond yield at zero. They widened the leeway for it to move a little bit over the years, but that was pretty much the only pressure valve. And you ended up, of course, in that scenario, just getting the yen just with sand kicked in its face and sliding to these multi-decade lows, almost like generational lows against the dollar, levels not seen since like the 80s. And that's kind of where we are right now. The BOJ has normalized, to zero, but still this interest rate gap between the developed world and the BOJ settings are enormous. The idea that this is the start of an interest rate cycle, I think, was something that was propping up the yen. The communications around this hike are more, sort of our view has been that this was more of like a tactical and opportunistic normalization rather than the start of an actual tightening cycle. And I think that that's kind of that realization, I think, is what is taking the yen on this next leg lower, which is, the BOJ has gotten them back to zero, but it's not clear that they're going to be going, a whole lot further in any time soon. So,
John, do you think they would have been better to not kind of prepare the markets for this and kind of surprise them?
I don't know. It's the rule of thumb for monetary policy is you want to lay the groundwork and all that stuff well in advance. But the BOJ has had a penchant for surprising, and maybe under the previous governor,
right.
Kuroda, it was more of the sort of pulling rabbits out of hats. In fact, the negative interest rate was a big surprise. Right. When he did it, after years of saying he would never do it. This was so the new governor Ueda, maybe is trying to be a little bit more transparent. With something like the interest rate hike, I think projecting it ahead of time is the right thing to do. With yield curve control, I think surprise was of the essence in some of those policy making, because you don't want the market to front run it quite so forcefully if you're really on the hook for keeping that yield tame. Anyway, don't want to get too far into the weeds on the because they abolished yield curve control as well. So they still, when you look at Japanese inflation and price trends and the demographics, there's still a lot of disinflationary headwinds that they're facing. So you got to feel some sympathy for the BOJ.
Yeah, and obviously a lot to watch, but we'll leave it there. I appreciate you guys coming on as our first crossover, hopefully one of many crossover episodes. Before you guys go, what do you guys have on deck? What else are you watching coming up that we can look for on the Macrocast?
The NCAA tournament.
Love it.
Definitely going to be watching that very closely.
By the looks of my bracket, I'm not a good guest for that one, but yeah.
I think one of the things that we're going to be watching, and this is of great interest to us, if you flash back to the previous presidential election in 2020, you got to see kind of, if you look at the stock market, right, you can identify sort of the Trump basket and the Biden basket, which stocks are, going to be favorable, are going to get a benefit from the election of a particular candidate. And you could see sort of by the end of the summer, sort of the late July into August period, you got to see, the polls were showing Biden pulling ahead, and you got to see these kind of Biden trades, like the ETF of solar and clean energy infrastructure and all that stuff started to run up, and it ran up into the election, and then did this kind of last big spike after the Georgia runoffs went Dem. And so it'll be very interesting to see. We don't think it's going to happen until later in the summer when the markets begin, the election is sort of within an investable time horizon, and market participants begin to sort of really parse the polls. Maybe the polls are a little more meaningful when you get to the end of the summer and past the conventions and so forth, that, the trades associated and the market trends associated with the competing economic policies of the two presidential candidates will be expressed to some degree in financial markets. And they're so divergent but the polls are also really close. So it's going to be a really interesting exercise to see which, how the market places its chips on this political table when the stakes are really high and the odds are pretty narrow.
Well, we'll be tuning in. That sounds like a lot of great insights coming up. So thank you guys again for joining. We'll have you back on soon, no doubt. But and to all our listeners, thank you for tuning in. Remember to like and subscribe wherever you listen to your podcasts. Follow us on X at PentaGRP and on LinkedIn at Penta Group. Additionally, as we've mentioned, you can hear more economic insights from John and Brendan on the Macrocast, a podcast now from Markets Policy Partners, released every Friday afternoon. As always, thanks for listening to What's at Stake.